Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 253 of the Independent Advisors Podcast, where Mark McEvely and I, Matt Jessup, bring you everything you need to know from the past week in the world of financial markets and financial planning. This week, I have Nick Whitaker sitting in for Mark, who is traveling on business. Nick, welcome.
Good to be here, as always. We haven't done this in a while.
We have not done this in a while, and I have been excited for this podcast episode.
Yes.
For viewers and listeners, I had the blessing of playing a round of golf with Nick over the past week.
Oh, yeah.
And I got to tell you, everybody, Nick has a very smooth swing. Very smooth.
Smooth, and it's in the ball goes in the woods a lot, but it looks good, I suppose.
Nah, you're a little bit better than you give yourself credit for. Very smooth swing. It's like silk. So, as always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from YCharts, and it is as of the market close of last night, May 22nd. Nick?
Yeah, so the S&P 500 is up 5.4% month-to-date and 11.3% year-to-date. The Dow Jones is up 4.9% month-to-date, 5.3% year-to-date. The NASDAQ Composite's up 7.3% month-to-date, and 11.9% year-to-date. The iShares Russell 2000 ETF, think small caps, is up 5.5% month-to-date, 2.9% year-to-date. The Vanguard FTSE All-World ex-US ETF is up 4.6% month-to-date and 6.5% year-to-date. The 3-month Treasury rate is currently sitting at 5.45%. The 2-year rate is at 4.86%. And the 10-year rate is at 4.43%.
Yeah, interesting. With the markets kind of pushing against all-time highs, I have a couple of pieces here in a bit, Nick, that's going to talk about how that's played out historically, because I know the psychology of an investor is what when you see these all-time highs. I'm not going to put new money to work at these levels.
Yeah,
right.
That's very much the thought process,
right? And then we had a conversation, back a couple of months ago. Market was rallying in November, December, January, February, March, and then people like, well, I'm going to wait for the sell-off to put money to work. You got your chance in April. Did you take the fat pitch? Did you let it go by?
Yep.
And now we're back with a pretty quick recovery 2 weeks later, right? Yep. So let's transition into big headlines and current events. Nick, I know you had a couple of things. I'll let you kick it off.
Yeah, so two major things that were kind of dominating the market headlines over the past week. And one is Nvidia earnings.
Yes.
And the second is the FOMC minutes. So
yes.
Nvidia earnings were last night. They performed well, I think, as the market expected.
Yes.
They rose in the post-market. They're up in the pre-market. It was a bullish sales forecast and a first quarter earnings beat. A little sweetener on there as they're planning for a 10-for-1 stock split. And I'll say that when we talk about Nvidia, and I'm actually going to talk a little bit about them a little later as well.
Correct.
It's not a recommendation for or against the name.
Yep.
More just these are big talking points in the markets, and we want to educate listeners.
Absolutely. And, I think NVIDIA gets a lot of headlines because it's kind of at the epicenter on the hardware side of anything that's AI related, right?
Exactly.
Yeah.
Exactly. Which is why it's such a big narrative and
sure.
Such a strong company. But we'll go into that.
We'll get there. Yep.
The FOMC minutes came out yesterday. The S&P fell from all-time highs and the Treasury yields climbed after the Fed minutes signal policy makers aren't in a rush to cut rates. Many Fed officials question whether policy was restrictive enough, and some even mentioned a willingness to tighten further if needed. So the minutes were a little bit more hawkish than the market wanted to hear. So we did see the market fluctuate immediately when those minutes came out. The market kind of pulled back, not in a crazy way, but we're talking on a one-day scale.
Sure.
So we'll see what happens there. Not a major moment for the markets, I don't think, because I think a lot of people were expecting that. But The Fed officials are definitely ramping up the communication about staying high for longer. So.
I'll be very direct. I said this on the podcast, and I'm not going to hide these feelings. I love this, and I'm going to tell you why. When you look at the data historically, and this is a very important point, the longer the Fed holds rates where it's at, and once they cut, the slower the pace, historically, that's great for risk assets.
Yeah.
Now, what is the risk of that? The primary risk, and I'm going to use the airplane analogy, is that they keep rates too high for too long. Using the airplane analogy, the airplane loses lift, starts to lose altitude quickly, and they're going to have to catch up. If they stall the economy out, that's when you're not going to see just a quarter of a point cut. You're going to see like a half a point cut at these meetings.
Yeah.
And my words of wisdom.
Or have to cut really quick.
Or have to cut quick in between meetings.
Yeah, you cut. Or just even like cutting in like a 3-month period, right?
Exactly. And so I would just throw it out there. Your tell over the next 1 to 2 years is the pace of the cuts once they start. Mm-hmm. If they are slow and methodical, historically, that's good for risk assets. And I had the data point I talked about in the podcast previously. But if they are quick to cut, I think that tells you there's underlying weakness in the economy, and they're trying to pump that patient full of medicine.
They're trying to catch up. Yeah,
trying to catch up.
Yeah,
so just
100% agree.
Words of wisdom there, and that's going to be your tell. I think that there was a lot of feelings, Nick, being a presidential election year, that there might be political pressure for them to do at least one cut between now and the election. And everyone's speculating it would be that September meeting. Personally, I really don't want them to do it.
Technically, so listeners are aware, they should be remaining the Fed should be completely independent of all of that, technically. Yeah, I think it's all going to depend on what we see in inflation between now and September.
I agree.
If inflation comes down significantly and the consumer numbers aren't looking as strong, then I could see the cut. It also wouldn't surprise me if we did not see a cut until maybe 0 cuts this year. That would not shock me.
I got a hot take on this.
I'm here for it. I'm always here for the hot takes.
All right. Personal opinion. I'm going to stress that. Personal opinion. Inflation, CPI is not going to go under 3 until the government stops printing as much money as they are.
Yeah.
I know it's a hot take, but the pull of getting inflation from 3 to 2 with the way the government's printing money, that's a tall order.
Yeah. That's the hardest part.
The analogy would be like someone coming up to me right now who's not training for a marathon and being like, okay, Matt, after the podcast, we're going to go run 26 miles.
Yep.
Could I do it? Possibly. Yeah. How long would it take me? A long time.
A long time. Yeah.
Would I be dead for the next couple of days? Yes.
Yeah. And so for listeners, it's much easier for the Fed to get inflation from 7% down to 4%, from 8% down to 3% than it is to get it from 3% to 1.5% or 3% to 2%.
Those are hard incremental gains.
It's much more difficult.
Hard.
But I think they're doing it right, where they're just keeping rates steady.
I just question. I don't think it's going to get much lower than where it's at until the government. Now it's a government printing issue.
Yeah, I agree.
I think the Fed's out of levers. There's
a fiscal side to it for sure.
Yeah. Hot takes early on in the podcast, Jenna. Hot takes.
We're already on a tangent.
You're already on a tangent. All right, the one that I have is proposed tariffs by the Biden administration. I want to throw this out there. This is surprisingly not getting hardly any headlines. And trying to stay not biased politically, I think that the reason this is not getting headlines is previously the media was very critical of some of the tariffs that the previous administration had enacted. And it's just interesting how you see this and it's not in the headlines. So the first thing is they're proposing on steel and aluminum, the tariff rate. Now remember, a tariff is a tax on a foreign made product coming into the country. The tariff rate on certain steel and aluminum products would increase from 0 to 7.5% to 25%. Wow. Okay. This is all proposals. Okay. Yeah. Semiconductors, the tariff rate on semiconductors would increase from 25% to 50% by next year. These aren't small numbers.
Yes, that's massive.
Batteries, battery components, parts, and critical minerals. The tariff on lithium-ion EV batteries would increase from 7.5% to 25%, while the tariff rate on lithium-ion non-EV batteries would increase from 7.5% to 25% in 2026, and the tariff rate on battery parts will increase from 7.5% to 25% in 2024. There's some more information regarding that topic, but for time, I'll go to the next one. Electric vehicles, EVs, the tariff rate on electric vehicles made outside the U.S. would increase from 25% to 100% in 2024. It sounds like the administration is concerned predominantly of some of the new Asian manufacturers of dumping their products and hurting, say, American automotive manufacturers. It's a good way of saying it.
And especially in the green space.
Yeah. Solar cells, the tariff rate on solar cells, whether or not assembled in modules, will increase from 25% to 50%. Ship-to-shore cranes, 0 to 25%. Even medical products, tariff rates on syringes and needles would increase from 0 to 50%. Certain PPE, personal protective equipment, including respirators and face masks, the tariff rates would increase from 0 to 7.5% to 25%, just to name a couple. I want to throw this out there because historically when you see tariffs, they're meant to protect domestic production, right?
Yeah.
But there is a concern when you enact tariffs that it could cause inflation. So it's interesting. I'm not for or against what is being proposed here. I just want to throw them out here that, take your personal politics aside. All administrations enact protective tariffs to protect industries that are important to them. And the Biden administration is no different from the Trump administration, which is no different from the Obama administration and the Bush. Keep going back.
Yeah.
Okay.
They all have to work with macroeconomics.
You all got to do it, right? All right, so let's transition to tweets, articles, and research from the past week. I made the comment before the podcast started. I got some bangers this week, okay? And I'm going to start off with some heat. The heat's coming.
All right, I'm here for it.
Okay? So the first thing I got is, this is a post from Seth Golden, and the post is from May 15th, and I absolutely love this post by Seth. This is the quote he put with this chart. Quote, "But I don't want to invest when the markets are at an all-time high." And he followed it up with, "Oh, yes. Yes, you do." There's a piece he has here that goes back to January 1st of 1988. And what it shows, Nick, and Jenna will put this chart up for our YouTube viewers. This will be in all of our show notes and all of our social media sites. It shows the average cumulative S&P 500 total returns, and it shows the difference, Nick, between investing on any given day since January 1st of 1988 and what the subsequent returns would be 3 months later, 6 months later, 1 year later, 2 years later, and 3 years later. And next, it shows the same data points anytime the S&P made an all-time high, the same forward-looking data. And I want you to tell listeners and viewers what this data says.
The data is pretty clear. To buy at all-time highs, or to buy at all-time highs, yeah.
And I know this is a psychological issue for a lot of investors, right? Because, we want to buy stuff that's at a discount. I want a deal, Nick.
Yeah.
I want a deal, man. I don't want to buy at full price. I don't want a full price.
Yeah, buy one, get one. We love a deal as consumers.
But when you look at history, the point I want to make here, and it's an important one, is just because the market is hitting an all-time high, at least going back to 1988 in this data set, doesn't necessarily mean that investment returns are going to be less than if you bought when the market wasn't at an all-time high. That's the point I want to make.
Yeah, absolutely.
Now, does the data actually look better if you were to buy at an all-time high since 1988? It does. But my point is I want to get rid of the narrative that doesn't make sense to put money to work at an all-time high. The data at least doesn't support it.
Yeah.
So what that says to me is that's a psychological notion that is dispelled by the data.
Yeah, absolutely. And it depends on your time frame, of course. We should caveat that, right?
Well said, Nick.
But if you're in
I
the
think
market,
it goes with all stock investing.
It does, absolutely. But if you're in the market and this money is, for the next 20 years, 30 years, yeah, it's no invest at all-time highs.
That's right. Because I'll give you the opposite side. We can go back to 2022, and there were some dark days in 2022. Just because the market sells off 10% or 15% doesn't mean it can't sell off another 10 or 15%.
Yeah, exactly.
Because just because the market's at a low point or it's corrected doesn't mean it can't correct more.
Yeah.
Right?
And
Works both ways.
And we've seen that time and time again.
That's right.
Yeah.
All right, my next piece, this was really interesting. This next piece is recent inflation data, and it's related to household net worth. There is a gentleman who is a George Mason, an old Atlantic 10, A10 school, George Mason University Foundation professor of law. You want to help me with pronouncing this gentleman's last name?
Not really.
Okay. How about I spell it?
Zwicki?
Zwicki. So his name's Todd. Last name is spelled Zywicki. And I could see like half of our listeners, they're probably in their car right now listening to the podcast like, come on, Matt. I can pronounce that.
Yeah.
Right? But he had a good post, and the post was from May 19th, and he took a picture. You could tell he took a picture with his smartphone of the Wall Street Journal had a piece, and it shows two charts, okay? And his caption is, haven't seen this chart before. And it shows two charts. One is the change in household net worth since the start of the presidency. And it shows nominal value of Trump versus Biden. And it shows their progress towards their term, their 4-year term. But underneath that, it shows it adjusted for inflation. Now, the data doesn't look great right now under the current administration, especially in light of the inflationary data. Mm-hmm. Why am I highlighting this? I've talked about on the podcast for years, Nick, about inflation and how it affects the purchasing power of the consumer. Mm-hmm. And we are in an environment, right, especially after 2022, where risk levels of the average investor have not normalized. I can have a lot of data that backs that up. Mm-hmm. And another way of saying it very directly, and this might be a crude way of saying it, people's stock allocations are not back to where they were pre-2022, right? Yeah. 2022 scared a lot of people out of the market. Mm-hmm. It was kind of that scared straight of, this is the risk. This is the risk of investing in equities. Mm-hmm. You're going to have years like 2022.
Yeah.
Okay. The problem is that when you overly invest a good portion of someone's net worth in safe assets for an extended period of time, and then you have inflation hit the way it has, you're losing purchasing power.
Oh, yeah.
And now you're seeing it in this chart on a household level.
Yeah.
And I just want to throw it out there that literally the average household in America, adjusted for inflation, the past 3 years is flat when you look at this chart. Mm-hmm. And I just want to throw it out there that that's a tough pill for a lot of people to really swallow. It's like, hey, Matt, but wait a minute. My house 3 years ago, I'm going to use simplistic math, was worth $100,000, and now it's worth $130,000. Woohoo! Mm-hmm. But what's the purchasing power on that 130 if you were to sell it and do something with it?
That's the issue.
That's the issue I want to bring to light.
Especially with the current rate environment. Yeah. In
now,
that example.
Do I think we're going to be in a hyperinflationary environment the next couple of years like we saw initially in the pandemic? No. But do I think we're going back to sub 2%? Not until the government stops printing money at the rate they are.
Yeah.
That's the point I want to make with this. Any comments that come to mind for you?
The only comment I'll make, all excellent points and very well said. The only comment I'll make is when listeners view this chart, to think more about the macroeconomics of the timelines of each president, because obviously this is looking at
Well said.
because I'm a firm believer that macroeconomics are the driving force behind most presidential reigns. If you're dealt a tough economy, if you're dealt that hand at the beginning of your term, you're dealt a tough economy. There's nothing you can really do to change the global economy.
I mean,
And there's a big piece
think of Bush
that.
in his second, with the great financial crisis.
Exactly. Exactly. And did he have anything to do with that? Absolutely not.
Yep.
He inherited that. And so there's definitely a little bit of that going on with the red line versus the blue line.
Well said.
Where the red line, the economic conditions were much more favorable.
Yep.
Than the blue line. And that is just something to keep in mind. I think so many people in our society get wrapped up on a name and think, oh, it's all because of that name. This presidential candidate is so great and this presidential candidate is so bad.
Couldn't say it better.
Global macroeconomics is a big deal.
It is. It absolutely is.
And will continue to impact presidential terms for the rest of
there might be
life.
times where people vote with their personal politics. There might be other times people might vote with their economic interest in mind.
Right. And so that's one thing that jumped out to me in this chart. It looks bad for the blue line, but there was obviously more macro pressure.
Yeah.
Relative.
It's interesting to look at it with inflation, isn't it?
Oh, yeah, absolutely.
Super interesting.
Yeah.
So my next piece is an update on market volatility. I'm going to be discussing some charts from Bespoke Investment Group on May 22nd, Nick. It's going to be referencing something called the CBOE Volatility Index. So let's take a step back. The CBOE Volatility Index, or the VIX, VIX as we call it in our industry, measures how much people think the stock market will go up or down in the next 30 days. I'm giving a very crude definition for our listeners and viewers. It's often called the, quote, fear index because it shows if investors are feeling nervous. When the VIX is high, it means people are expecting bigger changes in stock prices. And when it's low, they're expecting things to stay pretty much stable. It's a way to say how confident or worried investors are about the future of the market.
Absolutely.
What's your thoughts on that explanation, Nick?
Yeah. The fear index is really how I think about it. When the VIX is pushing, all-time highs, there's notable amount of angst in the markets. There's angst in the headlines. You can, having been in the market, and you can attest to this as well, following it every day. When the VIX is high, you can feel it in your
well said
in the market.
It's
you can
palpable. You can
feel the angst. So when it's low, sometimes you don't feel it, and you're like, it's because the VIX is at 12.
Yeah, and so a good reference point for me is anytime it's below a level of 15, you got pretty good complacency.
Yeah.
Anytime it's above 20, you start to get on guard.
Yeah.
Anything above 25, you're like, all right, get some popcorn. This is interesting.
Exactly. Yeah.
And, okay, why am I highlighting this? You're about to see. So the first chart that Jenna's going to put up is going to show the CBOE Volatility Index for the last 12 months. This will be in our show notes. And you had roughly 3 spikes in the last 12 months of over 20. Okay? But guess what? Just recently, we've had our lowest close since November 27th of 2019. Okay? Was the recent close that we had on the VIX. The next chart is going to show the VIX streaks without a close below 12. And we went 1,137 consecutive days without the VIX closing below a 12 print. Now, for our listeners and viewers, this might not mean much, which translates into my next chart. Going back to 1990, Nick, how many times has this happened? 5. 5 times. Okay? And so it only happened 5 times where the VIX streak of a year or longer would then broken and the VIX went under 12. Okay? This is not a common occurrence in the market. Okay? And when you look at the data sets, after an extended period of volatility that then subsides, these 5 instances going back to 1990, and you look at the forward-looking returns, they're not bearish, okay? Now, is this guaranteeing that the market's going to be higher 6 months from now, 1 year from now? Absolutely not. It's a data point. But I want to bring it out there that volatility, the points I want to make to listeners and viewers, volatilities come in. That is not a negative if you are bullish on risk assets. And this is definitely a uncommon occurrence when you look at history. And it's definitely not bearish.
Definitely not. I love this second chart. The second chart's really, really great.
It's eye-opening.
Yeah, it is. It is. It's a nice way, especially going back to what we were talking about with the fear index, and you can really feel it in the market because 2022 did feel tough.
Yeah.
And the 3 data points that jump out.
The only gotcha is the COVID. The only gotcha is when it happened in November of 2019. Because what happened 6 months later, 4 months later, is you got the onset of the pandemic.
Yeah,
right?
and I'm trying to look at like the trigger points here. So into 2018, that was the kind of like the flash crash with the quant trading that happened.
Yep.
That was kind of scary, but it popped back really quick. So it dropped 15%, but came back in January. Then you have 2008, right? Okay, we all know what happened there.
Yep.
Then you have the .com bubble. Okay, got it. And then the early 90s, which is
right after the Gulf War.
Right after the Gulf War, yeah. So it makes a lot of sense with how the market has behaved, and the narratives.
It just falls into this narrative of just don't sleep on the market. Just because the market's hitting all-time highs, and it's not guaranteed by any means, but doesn't mean it can't keep going higher. And this low level of volatility is the perfect ingredient to add to that recipe, in my opinion. This is not a bad thing.
Yeah.
So I'll turn it over to you, Nick. What do you got for listeners and viewers this week?
Yeah, the first thing I have is about the resilience in the U.S. economy. This is a tweet from Charlie Bolello. He says, or he's quoting actually, "There has been no incubator for unleashing human potential like America. Despite some severe interruptions, our country's economic progress has been breathtaking. Our unwavering conclusion, never bet against America." And that's a quote from Warren Buffett. And then Charlie threw a chart of the U.S. real GDP here over time, and you can see why Buffett said that.
Yep.
And this kind of gets back to a lot of what we were talking about earlier with investing at all-time highs. One of the reasons that we can invest in all-time highs is because of this chart, right?
Yeah.
U.S. real GDP continuing higher and the economy continuing to expand, and America being the incubator for innovation that it has been really since the beginning.
Well said. Well said.
So pretty simple chart, but sometimes it's nice to see this kind of really big picture chart and just remind people of why this is in many ways a very innovative hub of the world.
Absolutely. Well said. Well said.
My second piece is on the last of the bears among Wall Street investment strategists. This is it's actually kind of spread out across 2 articles here. The first one's about Morgan Stanley's Mike Wilson. So I'm going to read a little excerpt from one of these articles. "The strategist whose bearish 2023 outlook failed to materialize as markets kept rallying finally gave in and boosted his target for the S&P 500 to," and I say boost his year-end target.
Good way of saying
boost his year-end target for the S&P 500 to 5,400 from 4,500.
That's a massive difference.
Yeah, it's massive. That catapults his forecast from among the lowest on Wall Street to one that projects a fresh record for the index. And then Wilson said the following: "In the U.S., we forecast robust EPS growth alongside modest multiple compression." Wilson wrote in a note on Sunday, to his Morgan Stanley colleagues. And there's a chart we'll throw up here that shows that he's changed his 12-month target here. Mike Wilson really made a lot of news in 2021. He called the pullback in 2022, which just goes to show you that in the long run, it is always good to be long only and just sit tight with the markets. You're going to have volatility, but if you would have just sat tight in 2021, here we are.
That's a good way of saying it. You know, this might be a slightly hot take, but I'm just going to say it. You know, a broke clock is right, 2 times a day, right?
Yep.
And what happens is someone who gets a call right like that will then get notoriety, just like it happened after the great financial crisis. And my concern is that long-term investors change their long-term investment plan to try to time on a short-term basis those types of predictions.
Types of home runs, grand slams.
And then all of a sudden you're at a point where, let's say you were an investor who followed that. I'm going to give you the conundrum they're facing. They're drastically underweight risk exposure right now. Markets hitting all-time highs. What do you do?
Yeah. See, now you're behind, and instead of being conservative and hitting singles and doubles, now you're still reaching for the home run.
Yeah.
Yeah.
So that's that. And that's one of the issues. And what happens is then it goes back to my first topic at the top of the podcast. Well, I'm going to wait for those sell-offs to buy in. April happens, and at the worst of April, the market was down 6-7%. Tech sectors were down double digits.
Yeah.
Oh my gosh, this could be the beginning of the next correction. I'm not going to buy in. Market makes it back 2.5 weeks later. And I just want to throw that out there that this is a good topic to remind investors to stick to their long-term game plans.
Yeah. Yeah, investing is more about staying patient and hitting singles and doubles. It's not about hitting the home runs.
Yeah, I mean, you don't turn on the financial news networks and the show segment is called long-term money or slow money. What's it called?
It's fast money.
It's called fast money, right? It's sexy.
Yeah.
It gets you engaged, right? And, but the problem is that for most people in their long-term financial plans, those strategies and things that are discussed are not most likely in their best interest.
They're not applicable.
No,
they're not applicable to the style of investing that is needed to be successful in the markets over.
You think they're going to give me and you a show segment, Nick?
I think not.
I'm sure we can come up with a good name instead of slow money or long-term money. Maybe that's what we call it, long-term money.
Yeah, maybe. I feel like that's not what they're trying to sell.
Oh yeah. Okay. All right. We'll continue on.
So Mike Wilson, no longer a bear. He's now a bull. So that leaves one, Marko Kolanovic over at JP Morgan. He reiterated his view in a note to clients late Monday, urging them not to buy stocks while acknowledging that this negative outlook has hurt JP Morgan's model portfolio allocation over the past year as global equity markets rose to record highs. He cited a litany of reasons for maintaining his pessimistic position, including high valuations, the likelihood rates will remain restrictive for longer, elevated inflation readings, consumer stress, and geopolitical uncertainty. So there are still people out there who are very bearish. His year-end price target is currently 4,200, which is forecast a 20% drop, which would put us into a bear market. So he is quite literally the last bear on the street. And that's not to say Marko Kolanovic is a very sharp guy, very smart. Yeah. He was one of the leading voices in 2018 that was able to piece together for the market what happened when the market sold off.
In Q4 of 18?
In Q4 of 18 and around like December, end of November, when the market was behaving so erratically, he was able to get data and really give a narrative to the markets that made a lot of sense. So he's a very sharp guy. But I wanted to just kind of toss that out for listeners to show them that extremely smart people can be on very opposite ends of the spectrum, and then also at the same time change their opinions quite drastically, as we saw with Mike Wilson. So
I love how you're highlighting this.
Yeah, so just again, it goes back to the long term game plan. Hitting singles and doubles. These guys are paid to make the bold predictions. That's what their job is. They are not always right, as we have seen. Oftentimes they're wrong. It's a very difficult job, but that's what they're paid for.
My reply to this is as follows: at some point in the future, we will have a 20% plus correction. In fact, I hardly use this word. I guarantee at some point that's going to happen, right?
Charles Barkley guarantee.
So the problem is that yeah, let me get the buzzer. Is that going to be a day from now, or is that going to be 18 months from now, 24 months from now?
Yeah.
And the problem that a long-term investor has is you might see another 20, 30, 40% of appreciation before that 20+% drop.
Yeah.
That's the problem.
Yeah.
And which is why, for most people, investing for your long-term goals and objectives and risk tolerances is a prudent decision for most people. And the concern I have is that people will attempt to time the market on a short-term basis following this type of advice, and they could swing and miss.
Yeah, I think market timing.
You're lucky that if Mark were on this podcast, you'd get him really fired up.
Yeah, I was about to say, this would fire Mark up.
This would
sure.
really fire up.
Just stick with your long-term plan. That's what financial advisors are for. That's what
I'm glad you noticed this. You noted this because you eloquently said it so well, in my opinion, when you did this piece. Good job.
Yeah,
I like it, Nick.
Thank you. So the last piece I have is why so much attention on Nvidia, right? I realize I need to change this title because I had a typo in it. So these are a series of charts from Charlie Bolello that he put out last night during the earnings call. And the first one, and we'll throw these charts up for listeners. I just want to put these charts up to just give investors a visual as to why there's so much attention on Nvidia, why market narratives have changed on the chip space so much over the past, let's call it 5-10 years. Let's call it 5 years, actually. Let's call it 5 years.
I'm in.
Charlie says Nvidia revenues surged to a record $26 billion in Q1, up 262% over the prior year. Their revenue projections for Q2 is $28 billion, which would be a 107% year-over-year increase.
That's 107% year-over-year increase.
Yeah. For Q2, that's their projections. And then you can see the chart here for Nvidia revenue. So I'll pause here. Do you have comments on this and Nvidia in general and anything you have to say about the chip space and what's happened in the past 5 years? I'm sure listeners would appreciate.
Yeah, I mean, my 2 cents is definitely when it comes to technology in general, when you start slicing and dicing the sectors of the S&P, and the reason the tech sector has grown to be almost, it's not there yet, but it's almost a third of the S&P, the largest subcomponent sector of the S&P. Well, the reason for that is the underlying earnings growth, not just amongst semiconductor names like in Nvidia, but just the earnings growth has been drastically higher than all the other sectors of the market.
Yeah.
And one could argue that we are in kind of another economic advancement for the economy. People talk about the Industrial Revolution. Mm-hmm. We had the remnants of, the internet boom, and now people are trying to predict, and even Jamie Dimon in his annual shareholder letter, and I talked about that a couple months ago, we could be in the cusp of this AI revolution that could last multiple decades.
Yeah.
And I think you're seeing the spending and the enthusiasm behind that.
Yeah.
And the question I think investors are going to be challenged with, this will happen over the next decade, is we're going to go through instances where maybe the spending comes down for a little bit. And what do you think the question is going to be in the market? Is the AI spending boom over. Or is it taking a pause for whatever reason?
Yeah.
in my opinion, that's going to happen a couple of times over the next decade.
Absolutely. And it would be wild if it didn't happen. That
That's
goes
right.
to profit taking and everything we know about investing and economics.
See, what tends to happen in these boom cycles, and I saw this firsthand in the 90s and the 2000s, is you tend to have a mismatch between the evolution cycle of how fast they can build the hardware and how much they scale the software with it. And what tends to happen, and this is my personal observation, is you're going to have cycles where those things are going to get ahead of each other, and the spending on the one that's behind is going to be less until it catches up.
Yeah.
And so I saw this continually. You know, the challenge is going to be on the hardware side. They'll probably innovate on the software side quicker than they can innovate on the hardware side.
Yeah,
and
absolutely.
It's going to be the hardware developers that are able to innovate that are going to be the clear-cut winners. And so if I'm doing like my SWOT analysis on Nvidia, they definitely have a market-leading position, it appears, but it doesn't stop someone else from innovating and
Absolutely.
potentially overcoming that.
And when you say the hardware side, for listeners, you mean the actual making of the
Physical
chips.
hardware, the semiconductors, the microchips, the boards,
Yeah.
all that physical hardware.
And so to give listeners a bit more of an understanding of the chip space and Nvidia and all these other names in the chip space, to make those chips, especially the really super processor chips, those rooms have to be cleaner than a hospital operating room. There's less dust particles in a room to create a semiconductor chip than when someone is having an operation, a serious open heart transplant.
Well said. You're exactly right.
And so that's the hardware components of making all of that happen. The building, the hazmat suits, the machines that it takes to create them. That's what
They have to do them in areas where there's no seismic activity,
Yep.
which is why you're seeing them build them in places like Arizona and Ohio,
Yep.
right?
Yeah.
There's a lot of things that go behind it. And I just want to throw it out there that, okay, well, why has tech in general outperformed the last 5 years? Well, look at the balance sheets, look at the earnings growth
Right.
compared to the rest of the sectors. And I guess my main reply to this is someone could look at this chart and say, well, it's going to continue to go this way. And it very well could. But at some point, it will pause.
Absolutely.
And you're going to see these sales numbers where the year over year doesn't look great. And then you're going to have all the people come out of the woodwork say that spending cycle is over.
Yep.
And it may or may not be. And when you do have a pause in that, in those year over year numbers, that's when historically you see bigger corrections in the stocks that are associated with it. So when we start translating it into risk reward, since we're talking about Nvidia, again, not a recommendation for or against, I'm going to take what could happen. And I'll throw out two ideas. Someone else innovates on the chip side and provides more competition where they don't have as much pricing power. Ooh, that's not good for the stock price.
Nope. Which will
Or-
happen.
Which at some point could. And the next thing that could happen ultimately is what happens if you have an economic downturn and spending on chips is not there.
Yeah.
So again, could Nvidia continue to see these huge revenue gains that they've experienced the last couple of years continue? It absolutely could.
Could.
But I want to throw it out there that there is another side to it. There's no free lunch.
Right.
There, at some point, these stocks will correct.
Yes. And
Doesn't mean they're not going to go up after that. I just want to just
I
proving the
totally
point
agree.
that
Yeah.
there's risks in these names, even if it doesn't feel like it.
I totally agree. So we threw up the revenue chart for you. So just to give you kind of the brief historical what happened with the revenue, you go to 2020, you have COVID, which sparks a lot of work from home.
Yep.
Which sparks a lot of tech spending.
Yep.
Right. That kind of gets it kicked off. Then you have inflation getting out of control and supply chain issues.
Yep.
That really kicked off spending. Like you said, more people are spending because they're trying to get in line at the queue
Yep.
because of they need these chips to sell their products, et cetera, et cetera.
Yep.
Think about the car. We talked about this in the past, but think about cars, with how many chips are in a car. So
Yeah.
then you have ChatGPT come out and the AI revolution, and then same thing. So that that's why Nvidia and the chip space has really these charts. We'll throw up the Nvidia net income chart as well. Have really gone parabolic.
I mean, to talk about how parabolic it could go, I saw an estimate of energy consumption in the U.S., and they're estimating upwards of 2% of our power grid is being used on AI-related usage.
Yeah.
I've seen estimates from very legitimate research firms that are speculating that could be as high as low double digits by the year 2030 of our entire power grid in the U.S.
Yeah, I don't think that would shock me.
I mean,
I would.
If
I
that
think
turns
it might
out to
a
be
little
true,
high,
what does that
but-
translate into earnings for semiconductor names who are making this stuff?
Yeah, I think that sounds a little high, but it's definitely going to grow.
Yeah.
I feel confident in that.
Yeah.
And the last chart we'll throw up here as well. So we threw up the net income chart as well, so you can see that. And there's one more that just shows Nvidia net profit. And one of the reasons I want to throw this net profit chart up is so you can see the swings as well.
This is a good chart because this net profit will show you when someone has pricing power, there's a lot of demand and limited supply. What do you do as the company making that widget?
Exactly.
Yeah, raise the price.
Exactly. And so one of the reasons I want to throw this up is to kind of explain what's up with the parabolic move in Nvidia. Why is the market focused on it so much? That's why it's the AI narrative. It's chips. It's the next industrial revolution, maybe, ? Who knows?
Sure.
But I also wanted to talk and remind listeners that yes, it's parabolic, but I'm with you. Eventually, those charts will smooth out.
Yes, it will.
That is what I believe. And for those charts to smooth out, you're going to have pullbacks in certain assets. We've already seen it in 2022, and it pulled back, and then it kind of came back in 23, 24.
Doesn't mean that XYZ name, fill in the blank, and I'm not going to say NVIDIA, XYZ name, maybe not even the semiconductor space, might not do well over a 3, 4, or 5 year period, but you're going to be on a roller coaster ride during that time.
Right.
And is the average investor going to be willing to stomach a 40% correction, a 50% correction,
Yes.
a 60% correction
Yep.
to enjoy the 5-year return, say 5 years from now, that might be double digits?
Yes.
That's the question that a lot of investors are going to have a problem answering.
Yes, you have to. These are risky assets. Take a look at the net profit chart. That shows you how quick the pricing power can swing.
Yeah.
So, I just wanted to put up those charts, give listeners a little bit of a background, and if they didn't know kind of the history of the last 5 years and what's going on, hopefully that helps. Again, this is not a recommendation for or against Nvidia or any other name in the chip space. More just trying to educate and give listeners some interesting topics.
Wonderful. We're going to skip our financial planning topic of the week just with time. You and I had some nice roundtables today.
Yes, we did.
I knew we were going to have some bangers, and I was pumped about today's podcast. So a couple of notes before we get final thoughts. I'm going to start first with how we do our podcast hosting. We use Blueberry, and if you want to create your own podcast, you want to use the promo code JessupWealth to get your first month of Blueberry podcasting hosting for free. To choose the ideal plan for you, use the hosting estimator on their website. Again, you can receive your first month with promo code JessupWealth. That's all lowercase, no spaces. And in addition, talking about AI, Nick, if you're looking for AI software to help you note take, summarize a meeting, plan your action needed tasks, we highly recommend Firefly's AI software. You can use the link shown in our show notes to purchase your subscription and make life a little bit easier. Those are kind of my two comments on that side. And so as we sign off with episode 253, Nick, any final thoughts?
No final thoughts. I hope everyone is enjoying the spring, and Memorial Day weekend, right? So
yeah, I hope it's an enjoyable weekend for everyone. We've had some blazing temperatures relative to the time of year here in the Midwest. I think it's supposed to still be warm. Might not be 85 or 86 this weekend, but it definitely will be warm. So let's have a good weekend, and we'll see you next week.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.